I'm Javier Capape. I'm the director of the Sovereign Wealth Research Center at the IE Universities and International University Bercy in Madrid. It's a truly honor to have all of you here, our dear panelists. This is the second Sovereign Wealth Fund SDG conference. This is part of an initiative that was launched between IE University, the International Forum of Sovereign Wealth Funds, and the UN through the joint SDG fund. What is the goal here? The goal is very simple and it's very ambitious. The goal is to fix market failure, right? What is a market failure? A lot of investors are looking into Africa to have an impact, and a lot of African funds are already creating impact through their funds. How can we do to bridge these two investors, right? The international investors are looking to get an exposure to Africa through impact, and those sovereign wealth funds that are already doing that. So the aim is simple. One of the logics of sovereign wealth funds, and one of the most repeated words in sovereign wealth funds, by the way, sovereign wealth funds is a 10 trillion, well, now it's an 11.4 trillion industry dollars. They invest every year around 120, 150 billion US dollars in asset value. And we think that strategic sovereign wealth funds, which are sovereign wealth funds based in Africa that are doing or promoting development in Africa, they know better than anyone their countries. So the goal here is not just to reinvent the wheel and try to bring solutions that are already happening in Africa, right? So the initiative is about bringing these already happening investments to the planet, to the world. Get to know this, right? So why? Because strategic sovereign wealth funds have two key characteristics. They are enablers, or what we call catalyzers of foreign capital. They are very good in attracting investments. And we will see that in examples here. We have cases of Egypt, we have cases of Nigeria, we have cases of Morocco that is doing also at an African scale, right? With Obaid, we will hear later, Africa Sovereign Investors Forum is already doing this at an African level. So there is a lot of flow and interest on African sovereign wealth funds. The second big feature that describes sovereign wealth funds in Africa beyond being catalysts is that they are de-risking mechanisms. So when you get to a country, like in any of the countries in Africa, which are very different from each other, by the way, there is no such a thing of an Africa investment. There are many different countries and different opportunities you can find in Africa with very different backgrounds. So they can help you to de-risk your tool. They can help you to guide you, to tour you through the opportunities, to guide you through the legislation, to guide you through the regulation, to guide you through the investment strategic goals, right? So this is why we believe we need to connect sovereign wealth funds that are doing a lot of investments every year around the globe with sovereign wealth funds that are already doing investments that have a tremendous impact following SDGs in Africa. So if we are able to do that, we will just qualify sovereign wealth funds in Africa as enablers or catalyzers and the risking mechanisms. The question is, are we seeing any progress? And let me just give you some data on the overall global landscape of investments. The answer is yes. In 2015, when we started this Paris Agreement 7 years ago, by the way, we are in the middle of the deadline. We have just another half of the 15 years promise that we give to the world in 2015. By that time, only 230 gigawatts of solar panels were installed in the world. Today, this amount has multiplied by 5. So we have more than 1,020 gigawatts installed. If you think about carbon, by that time, 2015, only 12% of the carbon emissions were happening under a carbon pricing scheme. Today, this amount has doubled to 24%. So 24% of the emissions today have a price. And this price has gone from $7 per ton to almost, well, more than 4 times multiplied to $32 per ton, right? So we're making progress. If you think about another very important variable, FDI, right? Foreign direct investments. Back in 2015, 95% of the, back in 2015, 20 years ago, let me just go back longer, 20 years ago, 95% of the investments in energy that are taking place at FDI were on fossil fuels, 95%. Today, in developed markets, this is the opposite. 95% of the investment happening in energy happens to be in green energy. In developing markets, it went up to 80%, now it's getting down to 70%, and we have a reason for that. So this is just the global scale. What's happening with sovereign wealth funds, and I will be closing. With sovereign wealth funds, we have a good news too. Last year, 2022, it was the first year we observed in our research center, where we are publishing data at IE University every year on an annual report on sovereign wealth fund activity at the global scale. We were unable to track any fossil fuel investment. So for the first time in our 15-year data set, no sovereign fund was investing directly on a fossil fuel project. All of the energy-related deals happened to be in renewable energy. And that amount was 66 deals last year in renewable energy projects, right? This number is 4 times the average of the previous 4 years. So we have seen a tremendous momentum. In order to get and capture that momentum, we have this panel, and I will invite all of our panelists to come to stage in 30 seconds. This initiative is about this. It's about bringing capital that is already being deployed and to articulate a mechanism, what we call a fund of funds, that can get into a 1 billion fund that is able to attract international fund through a fund and distribute it across an initial cohort of what we call SDG Council that I'm happy to announce. We will have an SDG Council on sovereign wealth funds that are promoting and leading on the SDG transformation. So the idea is to make use of all these international financing capabilities to make it happen in things that are already taking place. We are not, again, reinventing the wheel. We need to pursue the 4th Senegal project on women. We need to pursue the next touristic development and sustainable project in Morocco, the next energy and agriculture project in Nigeria or in Egypt, right? We need to make it happen, and the time is getting close to the limit. We are halfway. We think that an initiative like this will be helping on that goal. So thank you very much. It's a big pleasure to have you all here. I invite all of our panelists to the stage so that we will be moderated by Victoria, and 4 sovereign wealth funds will show how are they progressing. Thank you very much.
This initiative that Javier and ourselves and the UN Joint SDG Fund is really important. As he was saying, investment into Africa is always just centered in 3 economies, and I bet you know exactly which ones they are: South Africa, Egypt, and Nigeria. And this is a really important initiative to really try and diversify investment into Africa by other sovereign wealth funds as well. So I'll very, very briefly introduce the panelists. We have Mr. Obaid Amrane, who is not only the chair of IFSWF, but he is the CEO of Ithmar Capital of Morocco. Mr. Ayman Soliman, who is the CEO of the Sovereign Fund of Egypt. Nana Maidugu, hello Nana, who is the head of sustainability at NSIA from Nigeria. And Rafael Matos from COFIDES in Spain. So I'm going to go really, and we don't have very much time, so I'm going to go straight into the questions, and I'm going to start with Rafael. Thank you. As we were saying, that the SDGs, we're using the SDGs as a framework now, and that's becoming much more common, I think, as we're moving away from ESG more towards the think about sustainability. Can you tell us a little bit about how you use the SDGs as a framework for investment, and how they're relevant and where you're going with that?
Fantastic. Thank you very much, Victoria, and it's a pleasure to be here among friends and among good friends and good known faces. Yes, I remember that SDGs. I remember that a couple of years ago I was having a chat with Javier from my university, because I was trying to pick his brain and his ideas to see how we could implement SDGs as a valid point as a pivotal point in our investment thesis, and we had a couple of discussions, and over that, at COFIDES we have applied a new program called COFIDES Impact, which basically is, how to explain it in simple words? Well, I'm not a very bright fellow, but I'll try my best. The main idea with COFIDES Impact was to make SDGs less aspirational in its broad sense and more operative from a point of view of an asset manager. And because I'm strictly convinced that the way in which you change the world is not exactly through incorporating ESG aspects all across horizontal issues. That is very positive, but you can lose sight of the track. You can lose sight of the objective. I think the way in which you change the world is in the manner in which you structure operations. When you get your feet dirty, when you get to the ground, and when you decide to apply aspirational goals, such as the SDGs, which are magnificent, to a project level. And that's precisely what we are doing in our operations with our African counterparts, in Latin America, and so on. We take a number of SDGs, we incorporate them into the lending, we define with our partners and our clients specific KPIs which are actively and specifically related to given SDG goals. And if that KPI is met, we apply a reduction in the pricing of the operation. So it's a way in getting your hands dirty in a good sense. You're something which is ethereal, something which is very high range. We take it down and we define KPIs linked to that precise financing with African counterparts to precisely that. So it's for us, it's right now, it's a structural part of our pricing strategy. And I think for us, it has become more than an aspirational goal. It is a day-to-day and operative goal.
Great, thanks. And Nana, you've got some really good practical experience of how you're embedding kind of the impact, social and economic, as well as the financial. So maybe you can talk a little bit about some of the projects that you've been doing that have really got that impact embedded into them.
Okay. Hello, everyone. I think before we talk about the projects, I will just provide a brief overview of how we integrate development impact in our investments. So we have a development impact framework at the NSIA using the theory of change and methodology. So this basically guides us on how we can ensure that our investments across our three funds are not only financially, do not only generate financial returns, but also generate social and environmental returns in line with national development priorities and UN SDGs. And through the application of this theory of change, we're able to do that. We're guided by 4 key principles, which is sustainability, ensuring, looking at it from a holistic point of view, and ensuring that we identify and address all the relevant risks to ensure that we provide or we deliver these financial, economic, social, and environmental returns. The second principle for us is impact measurement. We measure impact in line with national priorities and UN SDGs. The third is reporting, so transparency and accountability. We release an impact report annually highlighting how we are aligned to the SDGs. And even the selection of the sectors that we invest in is strongly tied to sectors that generate a lot of impact. Our key sectors on our infrastructure fund, for example, are in healthcare, in agriculture, in motorways, in financial markets, and these are sectors that generate a lot of impact, especially for a country like Nigeria. So for us, we do it through a sectorial selection approach, and as well as ensuring that across our 3 core funds, we embed development impact criteria in appraising investments.
Thanks, Nana. And Ayman, how is similar is your approach to what Nana's just outlined? Because you've got a very holistic way of thinking about which sectors you use with your sub-funds. So maybe you could talk a little bit about that.
Yeah, sure. Thank you. I'll build on Nana's point. We're quite similar. We are a real economy at Egypt, and we're sector-specific. The ESG components are very much easy, but as an emerging market, we know that the G is a big part of the challenge in doing business in emerging markets. And so we tackle that head on. We tackle that by making sure that our sustainable investment goals are aligned with government priorities. And this is how we speak that language. And once you get to deliver the government to deliver an SLA or deliver an ease of doing business in EMs, it is a big plus for investors to come in, and it helps facilitate a downhill relationship afterwards. So good alignment on sector specifics. And in Egypt, you can hit an E and an S in any sector you touch, be it education, be it real economy and agriculture. Logistics is a big growing business. Renewables, and this is a big part of the sustainability, and our goals reach far beyond decarbonizing our own economy, but we're actually helping decarbonize our neighbors across the pond, across the Mediterranean, and this is something we share together as North Africa, and the plumbing that we can create to help achieve that goal. So these are very ambitious goals, and that creates a good pathway for us to have very finite and well-defined investment sub-disciplines within our investment thesis. But of course, at the heart of our DNA is how to make sure that our partnerships are at par with global, familiar to any emerging market partnerships, and the co-investment model. This is how we align ourselves better.
Obaid, do you want to talk a little bit more about the co-investment model? Because I know that with the ASIF initiative that you chair as well, that this kind of bringing in other sovereign wealth funds and private capital as well is absolutely key to some of these projects and some of this impact. So maybe you could talk a little bit about the importance and how you're thinking about those partnerships.
Thank you. Thank you, Victoria. Perhaps a few points I would like to emphasize on to put things into perspective, and before diving into the question are, firstly, that for the case of Africa, given the huge development needs of the continent, any investment of development would achieve prosperity and cover and advance a number of SDGs. Secondly, most of the sovereign funds in Africa are strategic funds with the development and impact mandate, as it has been said by Ayman, or at least have a portion of their fund dedicated to development. They have not been set only to achieve financial profitability, but with a double bottom line approach, development and return, and Ayman and Nana will certainly confirm that in their testimony later on. They achieve that by being involved at the early stage of the projects, sometimes not just project, but also national strategies. They structure them in a way that would allow them also to achieve one important objective, being co-investment with international and private investors. By doing this, they can direct international capital toward real assets and maximize local impact and consequently SDGs achievement. And lastly, SDGs should be a catalyst of development and investment opportunity for emerging markets and not a barrier or an impediment. They need to be a balance between the criteria identified and their applicability in developing countries and in Africa or emerging markets. International investors should not consider investment only in a tick all the box from an SDG or ESG perspective, but rather adopt a balanced approach and seek to achieve these criteria over time. To come back to your question about scale, scale is one of the main criteria international investors are looking at when considering Africa. Indeed, as they don't have presence on the ground, they are unable to consider small transactions given a lack of human resources and the higher due diligence cost that could imply. We have heard that from a number of partners, including our peers in the Middle East here, where instead of deploying 100 or 10 projects, for example, they prefer to set up a 10 billion GV or invest in a one-off. This is why we came to think and initiate the Africa Sovereign Investment Forum among African sovereign funds. And here I'm very happy to have with me my Ayman and the NSIA, which are a very sustain this initiative. So ASIF is a platform grouping at date 12 sovereign wealth funds from Africa. Its objective is to promote and foster cooperation between the members through knowledge and investment best practices, but most importantly to aggregate, develop, and be a catalyst of transformative projects at the continent level. ASIF is currently considering the structuring of an investment platform for that. This can be achieved either by duplicating project for a country member or another, or developing project at a continental level, leveraging the strength and local expertise of its member, the sovereign funds. In this context of this vision, ASIF partnered with the UN body UNCTAD to collectively increase awareness about SDGs, driving investment and promote the adoption of SDGs in the investment strategy of sovereign and institutional investors in Africa. The idea is to leverage UN expertise in the topic, as well as the sovereign and institutional investor reach for a more efficient implementation of SDGs.
Thanks very much, Obaid. And I think that, that's really important about this kind of partnership at scale. And Ayman, one of your raison d'etre is to be the partner of choice for investors into Egypt. Perhaps you could talk a little bit about how those partnership works and how you think about alignment of values around the SDGs and impact when you're choosing and finding partners from the private sector and actually from your ASIF brotherhood.
Yes, thank you. So our starting point is a very sector-specific approach. Of course, each and every economy is different, and our pretext is different. So we read how our partners would look at Egypt as an opportunity, for instance, and as a market that's 110 million population. Yes, we are a good platform for agriculture. We're a good platform for renewables. We're a good platform for education, for social infrastructure, and there you find the starting points where you align the government and align your NDCs as far as sustainability investments are concerned, and that's how we do things. I think we pride ourselves with our growing portfolio in the Renewables 2X. The Renewable 2X program is a good alignment of infrastructure investments coming in. It's a real estate acreage game for renewables globally, and that race, I think the stats that Javier shared earlier are a good testament that this is the future of energy, the future of decarbonization, and also the future of economic double bottom line, economic development in emerging economies that are actually finding their way into the world to dent that energy market globally going forward. And that is the opportunity. So it is a compelling opportunity, and the race is all about getting there quick and efficient, and aligning ourselves as a co-investment partner. We also house a little bit of the development risk in-house, and we try and deliver government support towards the development risk. And this is a big part of how we get the inertia and to get momentum built up for projects to develop. From the last COP last year in Sharm el-Sheikh to this COP, the continuity of those projects and the momentum that's been building up, and the numbers and the stats that are helping to showcase that there is actual commitment and actual deployment towards those projects. Our portfolio has more than doubled in that space in terms of number of agreements inked and number of projects coming to the ground and coming to production. Starting from pilots, we're seeing that growth come to good fruition. So this is a good testament towards that. While we are doing that, we're also looking at generating emerging market returns in a very tight global economy where capital is becoming more expensive. The beauty of emerging markets, and this is, I think, what we all share the pride of, we generate above average returns. So everyone's looking for that risk-adjusted return. In our markets, you can find those double-digit IRRs. And when you find those double-digit IRRs, you adjust those for the tighter, and hopefully the tightening cycle is coming to an end. So that also lends a good segue for emerging markets to become attractive capital venues going forward, provided you deliver the good governance and the mainstream quality of investment partnerships.
No, I absolutely agree with you. I think in the last 12 months, we've really seen it feels like a tipping point where the momentum is building. And certainly in Kigali at the ASIF annual meeting, there was a real momentum about understanding what needs to happen. I mean, Nana, are you seeing that the last 12, 18 months have really seen a kind of a surge of interest, or are you just, how do you feel that, the conversation and action are developing in terms of sustainable development in Africa and investment?
I would say definitely there's been a huge emergence of and more focus on sustainable investments in Africa. A lot of the conversations we have, with the government or even with private partners is basically focused on some key areas or some key sectors of the economy that are looking to drive sustainable investments. So there've been a lot of conversations about renewable, energy, and us as NSI ourselves, we try and we're building our portfolio, expanding our portfolio in those sustainable investments. We recently launched our renewable energy platform, which basically invests across the renewable vertical in Nigeria. So upstream renewable energy manufacturing, midstream generation, and downstream distribution through sub-franchising with distribution companies. We've launched our healthcare expansion programs. So far we have 3 healthcare centers across the country, and we're expanding to 23 healthcare centers across the country. Construction has started, and we're looking to launch or cut the ribbon on a number of them within next year. So I would say definitely at a country level and as well as conversations with our foreign partners, that is the focus. And for us as an institution as well, that has always been the focus, driving sustainable investment such that every Nigerian is able to feel that impact. And through funds that allow us to invest outside the country, also apply those lenses and those considerations so that the impact can also be felt outside the country, within the region and beyond.
Thanks, Nana. And I think something's really interesting when you work in this region in particular is it's a very stark difference about how sustainability is implemented in emerging markets as it is in developed markets. I mean, Rafa, do you have some views on how, you can't apply the same rules to Europe as you do to Africa, and how that's different from your perspective? Because I know you've been doing some work, you do invest in emerging markets, so it'd be interesting to see how you feel that you have to adapt your approach.
Yes, it's perfectly valid, and I think, Victoria, you've just hit the nail on one of the biggest conundrums we have right now in Europe and in the sustainable finance sector, because the reality is that, and I think this is a good thing because it highlights that the concept of sustainable investing is mature. I remember a few years ago, there was no discussions among the community on what were the correct ways, how you could do things differently. It was back then a very black or white thing. We were all in agreement that we had to change things. But nowadays we have nuances, and that's good. And that's good because it means that the concept of sustainable investments, responsible investing in emerging economies and the developed world is changing. And there is a no one-size-fits-all approach when it comes to how to structure operations all throughout the world. For instance, I'm a super great fun, because I was involved with it professionally, on the whole European legislation package and regulatory package in terms of sustainable finance. It's super. It's fantastic. It's establishing common ground rules. It is establishing a common framework. It is putting sustainable investment at the forefront, both in terms of regulation and self-regulation by market participants. But the whole concept behind it is, in my opinion, a bit too Eurocentric. Because an investor such as ourselves that invests a lot in emerging economies in Africa, in Latin America, in countries that have different regulations than Europe, different energy matrices and systems, different transition pathways, it becomes a little bit more tricky. And I think there's a lot of room in order to generate common standards based around different taxonomies all throughout the world and based about different regulatory packages, which might be as fine and as applicable in Europe as elsewhere. And I'm very optimistic to what the future brings ahead, and I'm very I think we're going to see some good news and some good new messages on regulatory terms in the years ahead, because I think that the whole concept of sustainable finance has evolved, and it's a different thing nowadays.
Thanks, Rafa. I mean, does anybody else have any thoughts on that? Because I know that we talked a little bit about this in Kigali earlier in the year, about the challenges of attracting finance with the EU taxonomy, and there being that the kind of greater greening of industries that would be considered like just don't fall into the EU taxonomy, but are super important. I think Nana, you've got some views on this, so why don't you start on that one?
I think it's important when talking sustainable investment, when talking climate and climate finance, is important to look at it in the context of Africa. Because if, for example, you were to apply EU taxonomy to climate finance in Africa, you would have very limited projects that you could actually finance, because you can't, the level the playing field is not the same for everyone, right? So we have to do it in the context of where the region is at that point, what the region can leverage on to build industrialization to get to a point where it's able to transition. And for me, that I spoke about this yesterday. I said a just transition for me would be understanding that Africa is not at the same place or at the same starting point as more developed economies, and understanding that and creating some sort of flexibilities, especially around funds that are flowing into this region, especially around climate financing. Understanding that, I feel, is important in ensuring that this transition journey and expansion of sustainable investments in this part of the world is actually just and inclusive.
That's a really good point. And, this kind of just/fair transition, I think, is super important. Does anybody else want to kind of talk a little bit about that?
Just one small comment. So I think the EU has risen to the responsibility of speaking Africa. So this is a different emerging market, different nature of markets. And we're seeing also the diplomacy of sovereign funds. So that diplomacy, not only are we partners on many regulatory levels, on governance levels, on investment goals and targets and the double bottom line and that discipline, a lot of the European sovereign funds and some are actually waking up to come to realize that we are co-investing. We are creating jobs. Not only are you creating jobs back home, but you're also creating jobs in integration, in nearshoring, in some of those industrial ideas or investment thesis that are creating the momentum that fuels that. And this is a shared responsibility. We are walking a mile towards the global north, and I think now the global north is actually walking a mile because the partnership lends itself towards an equitable sustainability for both ends.
We shouldn't be dogmatic on those subjects.
Yeah, absolutely.
And when it comes to Europe and North Africa and general, what about the future of the Mediterranean region, I think that we have a shared responsibility to create a space of prosperity with sharing and developing the new green economy. And in this perspective, we should be very conscious that all the regulation should consider this aspect when considering the access to the market. I think that there are in Africa and in North Africa a very well designated spot to either generate green energy, but also having workforce to make the transition less expensive to Europe. And to avoid subsidizing, I think that this vision should be shared by the leadership to be transcribed into the regulation, which is not the case yet.
Well, I think that's a really nice, positive note. Now, I've got 2 minutes and 10 seconds, so I'm going to just go back down the line. One word answer as quickly as you can. What would you like to happen? What is your number one priority to kind of kickstart the SDGs in Africa? One or two words. Go, Obaid.
No, just to say, to complement what I was saying, we need not only discussions, we not only need projects, but we really need a good vision.
Vision, excellent. Ayman.
Decisions. I think the EU Commission is now realizing that they need to also help structure more bankable demand for emerging markets to achieve that bankability. It is a key ingredient.
Perfect. So vision, decisions, Nana.
I would like to see more. I would like to see all the words being put into action and increased flow of capital into the region. We, the sovereign wealth funds, are ideal partners for international partners, and they are bankable projects in this region. So we're waiting. Show us the money, basically.
Great. Excellent. And Rafa?
Two takeaways. Local ownership in sustainability aspects and strategies. and well-defined and repeatable regulatory frameworks.
Perfect. Well, thank you very much. And with 42 seconds left on the clock, I'd just like to thank my lovely panelists, Obaid, Ayman, Nana, and Rafael. Thank you so much, and I hope you enjoyed that.
Hello, everyone. Yeah, we continue with the event. It was a fantastic panel. So we have now Eric Usher, which happens to be head of UNEP, United Nations Environment Program Finance Initiative, and Mrs. Constance Chalchat, who happens to be a head of corporate investment banking and company engagement and global markets chief sustainability officer at BNP Paribas. So thank you. The floor is yours, Eric and Mrs. Chalchat. Constance. Thank you.
Wonderful. Thank you very much. And it was a great session. And it's great to be in the Energy Hub. If you want to be somewhere to see that the transition is getting underway, you come here. This is where it's really happening. And, you know, I often, many of you get the question of, are you optimistic? You know, is change happening? We see all the bad news. We understand the urgency. And I think one of the things that makes me optimistic is when I see the pace of change happening within the finance industry. Now, UNEP FI, we work more with the banking and the insurance industries under the frameworks of the UN Principles for Responsible Banking and Principles for Sustainable Insurance. We also work closely with the Principles for Responsible Investment, so on the capital markets side. And a lot of change is happening, and Constance is going to be able to attest to that. We, within the PRB, which now represents 50% of the global banking industry in terms of signatories, and actually the fastest growth is in this region right now, 91% have embedded sustainability within their governance and sustainability strategy at the board or CEO level. And that's the main change, is that this issue has elevated. And as we heard on the discussion now, when you hear leaders talking and their C-suite, the senior management, being responsible, even in terms of their compensation, we start to see the gears set in motion. And one of the institutions I will talk about often, global institutions who has really been leading this change, is sitting right next to me, BNP Paribas. They have been a driver of change. And the talent pool that you've amassed in this space, when I speak to young people about what to do, this space is one, particularly in the finance industry, but also elsewhere, that has so much opportunity. And I think within a big bank, it's one of the most dynamic areas. So with that, it really gives me pleasure, Constance, to share the stage with you. And I think the topic we're here to discuss around the role of African sovereign wealth funds is a critical piece, because myself, knowing on the banking side, banking plays such an important role within developing countries, within emerging markets. But in a market like in Africa, unless you have the investment piece solved, and we know that there are a lot of challenges, unless that we are moving together, we just can't put the capital stack together. We can't put the resources that are needed to drive forward what is a very significant capital mobilization, and requiring significant new ways of thinking, and also a significant new relationship with policymakers and regulators. So I hope we can touch on some of that. Constance, you have been doing some work at BNP around the appetite, I think, of the sovereign wealth funds to be getting more active in this space. Could you tell us a little bit about what you've been finding in your wider perspective on this challenge?
Yeah, thank you very much, Eric. So we did a lot of work, and what we do is we survey, because things are moving quite fast, especially in the market. So we like to document what we do and the strategic orientation we take. Earlier this year, we did a survey amongst institutional investors and distributors, 200 of them worldwide, very representative. And we had 3 key learnings. First, there is a real appetite for investment, thematic investment that delivers sustainable outcomes. And what's very interesting is this appetite is driven by the distributors. 77% of our distributors answering said they would like to invest or invest more in thematic investment. And that's versus 35 for institutional investors. Second thing, they correlate sustainable investment with long-term profitability. Over than 80% of them thought it's absolutely correlated. And the last thing was very interesting. It's what do they want to invest in? And there, what we saw is a real willingness to go beyond SDGs, to go into real thematics. So key interests were in climate solutions, but also social and health, as well as thematics like water, access to water. So there is a demand for it. So now I'm going to be the bearer of bad news. The issue is not a lack of appetite for sustainable outcome investment. The issue is how do you make them bankable? And there, what we're facing is much lower appetite for emerging markets. So this is because of three major risks. The first one is financial risk. Since 2020, 11 sovereign wealth funds defaulted. Now they're stuck into complex restructuring, and it's weighing on the market. Additionally, when you look at the issuance, pre-COVID, we had about $30 billion issued per annum by emerging markets. Since COVID, it's been lowered to $5 billion a year, so much, much lower. And today we have around 20 sovereign wealth funds in emerging markets that are have yields that are absolutely prohibitive. So it's making the cost of issuance absolutely unaffordable. And this is creating a massive financial risk, which is one of the major issues investors have. Second issue is operational risk. Operational risk, what we're seeing is quite high-profile emerging market projects are suffering from delays, operational uncertainties, and if you couple this with political uncertainty, that creates a risk which is sometimes unacceptable and makes the project not bankable anymore. And then the last risk, which has become extremely prevalent in the last 2 years, is reputational risk. So Nana, I was very impressed with what she was saying, but at the same time, you know, international banks, international investors, they're putting international money and they are obeying to international norms. They're obeying to the Equator Principle when financing projects, so they cannot afford to have reputational risk linked to operational risk. So it's as simple as this. So what do we need? We need DFIs, we need extra sovereign agencies, we need the world of development finance to step in and not only address the financial risk, but address those three risks at once. Financial risk, operational risk, reputational risk. If we have this, we can attract capital. If international investors are still facing two of those three risks, it is an issue, and that's what's refraining them to accelerate.
Can you dig in a little bit more in terms of what you see in terms of the solutions? Because we understand there's a lot of discussions around reform of the international financial architecture. It's complicated, but I think one of the challenges is, you know, the risks that are posed. How do you address them at a country's systemic scale? And I think that's one of the question marks that the MDBs will ask. You know, they can have instruments, but they go deal by deal, and I guess the need is obviously much larger.
Yeah, so it's I'm not sure I have the solution. I know that when we see what the World Bank is doing, it's quite interesting. They're bringing financial de-risking, but they're also bringing de-risking of operational risk with people, technical assistance, people on the ground. I think it makes a big difference. I think there's no one single solution and one size fits all. It's a multiplication of solution. We also see voluntary carbon markets stepping in with lots of possibilities to add true impact locally, but not at scale. I would turn the question to you, Eric. With the UN, we see a massive potential with a global presence. What do you think can be done, and how would you like to shape things?
I mean, certainly, as I mentioned in my opening, that there is much increased awareness, and I think part of it, and part of what we heard on the panel, is the notion of, you can have global norms, but unless you can land them in a regional context, it won't work. And so the question is, there is a process of translation. I think there's much more awareness on the issues that are to be addressed, and I think one of the important developments is around this notion of the metrics you need to track as a financing organization, risk, return attributes in their many forms, that the impact of your financing starts to become a key measurable. And we have the establishment of the ISSB, the International Sustainability Standards Boards, and it's going to become the norm to have a better grasp of what sort of impact are we creating with our financing. I think that gives us hope, because with that better information, with that transparency, it will allow a more efficient flow of capital towards, let's say, the European green bonds market into the place where real deep impact can really occur. But of course, there's a lot of work to be done. There's a lot of regulatory barriers that have to be addressed. There's a lot of capacities that have to be built. And there are some rather sticky challenges, as you're mentioning, that are going to have to be addressed, some of them one by one.
Yeah, I think we're all facing this, and I think we need to find a way to get investors to regain confidence into this market. We need some sovereign to step up with very bold vision. That was one of the key words said in the previous panel. Bold vision, but also extreme rigor when it comes to delivering on the projects, when it comes to impact reporting, when it comes to transparency, adherence to some a standard which creates the right level of confidence. And I think if we are able to demonstrate that it can work at a country level with 1, 2, 3 sovereigns, I think this can really flip and get the momentum going.
We heard mentioned in the role of, let's say, European institutional investors and sovereigns. Do you see the potential in terms, because they often complain that there are regulatory reasons why they can't get the capital into markets, for instance, in Africa. Do you see the potential of working together to bring capital into Africa in a way where the African sovereign funds are playing a key enabling role?
I think there's definitely an appetite. So it's a matter of solving the different issues and being able to find the right mechanism to solve them at once. And I think this will be absolutely crucial.
What about, we heard talking about the European taxonomy, and it's a big piece of regulation, the CSRD, which will require reporting against the taxonomy. We're starting to see analysis of initial reporting. It's quite interesting. You get a view, and for instance, of large European companies started reporting 8% of their revenues are sustainable based on the taxonomy, but 15% of their capex is sustainable. So you see the sense of direction, and you can also look industry by industry. Within the African context, and with the aim towards better interoperability over time, is there a need for African countries or regional taxonomies? Would that be support the flow of capital, do you believe, for instance, for European investors?
I think some level playing field when it comes to taxonomy is probably helpful. However, I wouldn't argue to get the EU taxonomy to be applicable to Africa. It doesn't work. I think really in the end, it's not about financing what's green. It's about helping and supporting the transition. So it doesn't necessarily mean, we don't necessarily need an absolutely green taxonomy to finance Africa. I think what matters truly is overcoming the financial risk, the credit risk, the forex risk, overcoming these operationality issue, and bringing clear transparency as to the impact and the do no significant harm translated to the African continent. I think this is going to be critical to attract European investors.
Well, what about the topic of resilience? And we have the huge success to start the COP with the agreement to establish the Loss and Damage Fund, which is a very good investment, I think, in the North-South sense of how to work together. But one of the questions around resilience is, if it's going to be a public fund, it's obviously going to be way short of what's needed. So is there a role, do you believe, for capital markets, for sovereigns in being able to capitalize instruments, for instance, parametric insurance and the type that can help countries adapt or react to climate exposures?
So I think it's two different things, the adaptation and the reaction. I think on the reaction thing, we are probably facing a difficult situation for the years ahead on the insurance, reinsurance side. We are seeing lots of insurers pulling away from some markets. I think there's going to be a very fast shrinking market when it comes to cat bonds, for example. So the reaction to catastrophic events is going to be less and less reassured or insured in a way. So it goes down to adaptation. How are we able to adapt quite fast? And unfortunately, for adaptation projects, there's no cash flows for a while. We all know this. So there is a clear role for sovereign wealth funds to tackle those adaptation projects. So the adaptation that needs to be done, but there's no cash flows. But if you don't do it, the cost is absolutely humongous. So again, it's a matter of how do we re-establish some level of confidence in some emerging market sovereign wealth funds, because in the end, I do believe the key is there. They're the one who have to invest for their country to adapt.
Excellent. I think a big thank you to the Joint SDG Fund for convening us here. Would you have any thoughts in terms of the fund itself and the innovation role it can play? It doesn't have the size of an MDB, but it can be very catalytic. And what do you think the role of the UN, our sister agency, where should they be putting their emphasis, do you believe, in terms of helping build out this space?
So first of all, we're partnering with the UN SDG Fund because we believe it brings complementarity to capital markets. I think you can have action where we can't. So it's absolutely fantastic. I think in the end, but you'll have to tell me afterwards your thoughts. In the end, I think you can play a role in financial de-risking and in presence on the ground, which is absolutely necessary. To be able to have this catalytic effect and bring foreign capital or international capital. So I do believe the initiatives like this are absolutely critical. I think there needs to be some complementarity between what the UN is doing but what DFIs are doing to be able to cover the whole spectrum of countries, to be able to leave no country left by themselves. I think the principle of just transition is ensuring that we are able to adapt all together. But how do you see the UN role and the UN SDG Fund role?
I mean, certainly in the end, we all know the issues that need to be addressed. Public treasuries will not do it, and they are certainly not in the shape today to address it. So it really is the question of what role can the private sector play. Private sector has the ability to innovate. Private sector has the deal to take commercial risks and to, most importantly, take things to scale. And one of the challenges in development finance is we do things one by one. We really want to be innovative, but then we move on to the next thing. So I think we all know that the responsibility will be in the hands of the private sector, and the role of the UN is to work with governments and with the private sector to say, how do we close the gaps which you've posed out? And of course, the development finance community. So it has to be a consolidated effort. I think one of the benefits of a COP, you say, what's the worth everybody getting on a plane? The reality is there's 100,000 people here. The only common thread is climate. Every part of the economy, every part of a society is here. And essentially, that's what we need engaged to solve these issues. We need everybody around the table. The UN is a great place for holding meetings, but hopefully it can do more and to help, but to play a specific role in helping get the pieces moving. In the end, the private sector facilitated by others who are going to help solve these problems if we look to the wider SDGs. I think with that, we have to hand it over to the organizers. Thank you very much, Constance. If we can give a hand.
Thank you very much, Eric.
Thank you very much. Thank you, Eric. Thank you, Chalchat, Constance, it was fascinating. Thank you very much to all of you panelists. We will close with Álvaro. Álvaro is the Deputy Director General Planning on Policy Concerns at the Ministry of Foreign Affairs in Spain. Spain, who happens to be now, in the second semester, occupies the presidency of the Council of the European Union. So my first question, or this open question to you can answer with a full stack, is about, we have heard the views of the private sector in Europe, we have heard the views of the United Nations itself, we have heard the views of the Association of Sovereign Wealth Funds, we have heard from sovereign wealth funds in Spain, from sovereign wealth funds in Africa, Egypt, Nigeria, and Morocco. How do you tackle this?
Well, good morning, everyone, and thank you for the introduction. And it's a really pleasure to me, to us, for Spanish Secretary of State of the Ministry of Foreign, to be here with us. And well, okay, thank you to and also Mubadala Pavillion hosting this event, and thank you, Javier, for University for the organization of this event, which we believe address one of the topics. It's been a start subject at the scopes, and this is looking for a new and innovative financial sources and contribute to accelerating the implementation of the SDGs, because you know that climate change is not only SDG 13. So I would like, after these interesting interventions, to put in place a problem that we all know, and which is this is not new problem, and which I have been hearing for 4 days in this scope, and this is the lack of financing to face the threat to climate change and the appropriate speed. So, and I also believe that taking account the last evaluation of the implementation of the 2030 agenda, this fact can be applied to the compliance with the SDGs as a whole, and it seems increasingly obvious that the current architecture of the development financing must be improved, even reformed. We think. So, for this reason, we think that this initiative, like the sovereign wealth funds, on impacts on NGDs, seem of special interest to us, to the cooperation, to UE cooperation, Spanish cooperation. And it's interesting because it meets several the key elements of Spanish and UE development cooperation and transition policies. Regarding the first thing, regarding for the UE, for the interesting or topics areas, such as African and Latin American and Caribbean areas, region. So on the one hand, funds are paying special attention to the Agenda 2030 and its SDGs as a central and guiding elements in development policies. That is our framework, the Agenda 2030. And on the other hand, this initiative search and structures new financing tools. So finally, it also impacts the force to search and synergies between actors, in this case national actors, through sovereign funds, but with participation on the private sector, which we think is absolutely necessary to this target, to our targets. Thus, Spain has been supporting the initiative through the contribution to the SDG Common Fund. So actually, we are one of the largest donors to this fund, and in fact, we are the second one donors, contributing approximately 120 million euros. So I could say we are really happy to see that the first cohort of SDGs Investing Council members identified as this will be a key platform to promote dialogue, exchange, and the best practice exchange of knowledge to support the fund sovereign wealth by integrating the SDGs into your investment and proceeds. So my last words is we congratulate University, to you, Javier, for the effort and the work, development, and to the other partners and actors involved. We encourage to remain involved and move forward. Also taking account the upcoming of the 5th Congress of Development Financing, which is, as you know, it will be co-organized by Spain, Mexico, and Ethiopia, and which will be held in Spain in 2025. So we have work ahead. And from Spanish cooperation to development, we will supporting and collaborating in the next steps, such as the launch of the next SWF and SDGs Council meeting in Madrid, 2024, and or in the expansion of other partners and regions involved in these initiatives. We think if we all contribute, we believe we can obtain a useful and successful tools and funds. And Spanish saying says, if you want to go far, go in company. And this is in the DNA of Spanish cooperation, which commits strongly to a multilateral approaching to the global problems. So this is our vision, total support to this fund, total support to the SDGs fund, and total support doing multilateral and doing partnership with this initiative and with all of you.
Thank you very much, Alvaro. We need to thank you because of the support to the joint SDG fund, because of the support of this initiative. Let me just close this event. It was fantastic. Thank you very much. It was fascinating. I think we have learned things that we need to be flexible. We need to be innovative in the financial solutions. I think we are at IE University well positioned to do that because we are the small fish and we are not a threat to anyone. And we don't have side interests. We don't get our money from making this, but we can think about what can be the challenge, what can be the solution that we can implement together. So with the private sector, with the sovereign funds in Africa, with international sovereign funds like the one in Mubadala here, we are hosting us. Thank you, Mubadala, for hosting us for this event. So being innovative, being brave, being ambitious, be very specific and flexible, adapt the taxonomies and the regulations to the local context and make it happen. I mean, we have the tools, we have the sovereign funds that are already doing that. Let's support them to make it faster and bigger. So thank you very much. It was a great opportunity to be here.